Hi, I'm Eric Dobson. I'm here to talk to you about risk and rewards in financial sense. So, there's a couple of reasons you should listen to me. One, I do lead an angel group. Two, we've had 7 profitable exits in 5 years with a IPO pending this month. And we've got 12 more companies we believe strongly will exit well over the next 5 years. So those are big risks. Those should all be big rewards. I've learned a lot of lessons the hard way, but that's why I'm here to talk to you today. So the first caution I would give you, the first caveat I should say, is that I am a tech investor and I lead other people to do these kinds of risky things. I'm not a financial advisor. So please do not take this as financial advice. All right, balancing risk and reward. We've all been there where you're walking down the street, you're heading to a meeting, and you realize you're going to be late, but if you jaywalk, you might make it on time. The risk is you could get hit by a car or you could get, a ticket. But the reward is you might make the meeting on time and not have to apologize and set up an awkward situation. We do this in our daily lives, if you think about it. So there are three central concepts that at least I think of when I talk about risk and reward. One is the risk itself. What are you prepared to risk? What's the reward? Personal knowledge and accountability. How how much knowledge do you have to accumulate, and how accountable are you for your mistakes? And of course, regulatory oversight. Which anyway, so risk and reward in the financial industry, they usually talk about it in terms of ratios, dollar risk to dollar reward. Okay, so let's talk about banking. Banking is very, very safe. If you want to put a certificate of deposit down, a CD, you're almost absolutely guaranteed that you're going to get a return on that money. Now, it's somewhere between 2 and 6%. Historically, the heyday of the CDs was in the 1980s. Now, post COVID, we're seeing 4 to 6% CDs on a 6 to 12 month fixed, kind of fixed rate. So, very safe. The likelihood of you losing that is just infinitesimally small, and it takes no accountability to think about it. You can just do it. The bank takes care of it, and suddenly you get your money back. These are what we call below market returns. Nothing wrong with that. It's just that there are for a little more risk, there's a little more reward, and you can balance these things. I think is how most people would think of it. But in banking, if you think about the ratio, it's probably 1 to about 1.05. Okay, so for every dollar you put at risk, your reward is a nickel. Again, not a bad way to go. It's just limited in returns. You can also think of mutual funds. Let's say that we're going to let a professional invest for you. This is reasonably safe. Okay, they spread your assets over multiple investments and classes. Best returns are in the 17% per annum, which is very healthy. In the last 10 years, of course, the average historically has been between 10 and 14. But bear in mind, of course, there are fees that you pay for the pros to manage your money. This is essentially what we call market returns, and the market return itself is usually considered the S&P 500. That determines what market returns are. So if you look at that, that's 1 to 1.2. So for every dollar you risk, you get 12 cents back per year. Now, whereas a CD is fixed, you can leave this in, and we'll say this is a 10-year average. Let's say you're looking at 1 to 2.2. So you're looking at something where you can more than double your money in a decade. The stock market, we're all familiar with it. S&P 500 is the gold standard, and it's going to average 10 to 13%. 13.2 for the last 5 years, but only 7.64 for the last three. And therein lies the rub. The stock market's very boom bust in its nature. So it's volatile. That's what we call volatility. So in this case, you're either going to use a professional to do it and pay fees and all that kind of fun stuff, or you're going to have to do your own substantial research and your own substantial work. So a lot of accountability. This is the gold standard. That's what we call market returns. So here we're looking at roughly, let's say it's a 13% average. Over, so for every dollar you risk, you get 13 cents back annually. So if you look at that over 10 years, that's roughly 2.1 to 2.3. So again, you're more than doubling your money. in a 10-year period by using that mode. Um, what I do is called private equity. We invest in companies while they're on the private side, expecting them to be acquired or become public, acquired by public companies or Fortune 500 companies, and then or become public themselves. So there's obviously a potentially big return when you invest in a startup company and you invest at a time when the company might be worth $2 million and then you exit when the company's worth 200 million. You can see that there are multiple times your money back potential. But there's also a chance of big losses. Most private equity investors will tell you that they lose 40 to 50% of their investments, go completely down the drain and return nothing, big goose egg. So that's the challenge here. You've got to become an expert in this if you want to do this. But the industry reports a 2.6x in 3.4 years. So 2.6 times your money back in 3.4 years. That equates to about a 26% annualized return. So that's 1 to 2.6. So if you think about that, so it's a penny, dollar risk, roughly you get 26 cents back. And again, if you average that over 10 years, you're looking at 1 to 3.6. So that's you're more than tripling your money in a decade. We have an IPO pending this month that we expect to be 1 to 10.2. So that's for every dollar we put in, we expect $10 back. So you can see how these things can be very attractive, but at the same time, any number of things can go horribly awry, and there's almost no recourse. All right, so 10 to 50. When you think of a balanced portfolio, this is what you should be thinking of. You should be balancing your saved and your assets in multiple classes. So you may have some relatively safe nest egg investments. You have some growth investments that tend to maybe it's mutual funds, maybe it's stock market, and then up on the very top end, the last 5 to 10% of your balanced portfolio can be put into really aggressive classes like private equity. Okay, so think of a balanced portfolio when you think of risk and reward. And again, only 5 to 10% should be your highly risky stuff. So let's talk about private equity. I said it's high risk, high reward. But if you think of personal accountability, it's the most personal accountability, and it's the lowest regulatory oversight. Again, if something goes wrong, you have almost no recourse. So here's the bottom line: never invest money you can't afford to lose in private equity. It comes down to your risk tolerance and cash needs at the end of the day. So if you've got a need for cash in the short run, foreseeable future, don't put it at risk. It's that simple. This isn't, I need to retire in a year, so I'm going to Vegas with my life savings. That is an insane thought. If you can wait out inevitable market shifts, then you can take a little more risk, and you probably should. So in terms of recommendations, big risk, big reward deals are very alluring, but you can lose your shorts. Assess your need for cash over time. Set personal financial goals. Create a balanced portfolio and a balanced plan, and then follow it. You should engage a wealth advisor you know and trust to help create a balanced portfolio with you. You may have to overrule this person to engage in private equity and do the stuff I do, but it is really about your personal risk tolerance and your immediate need for cash. That is at the end of the day, that's the risk reward ratio. Thank you. I hope you've enjoyed this, and we'll talk again soon.